Welcome back everyone to the Audacious Money Witch channel where we talk about investing and trading and a lot of fun things. The stock market's interest rate problem just got a lot worse. There is no turning back now. We have a fresh out of the box IPO stock, Reddit stock going up 30% in a day and year to date up over 75%. We have ARM stock, another IPO stock year to date up 88%, Nvidia up 92% year to date. We have Super Micro Computer year to date up 270%, about to be upgraded from small cap index to S&P 500. All these stocks are hotter than Bitcoin itself. All these are a sign of something. This is a warning.
The large caps, and the large caps only really, and a lot, are making new highs. This is insanity, okay? To be making new highs after all that's happened, but it shows the markets are on crack, okay? As I've been saying for many, many, many years, the markets are fully convinced the Federal Reserve and the central banks around the world will do whatever it can. They will be cutting rates rapidly if the economy shows any weakness, and they're already expecting this by June.
The Fed wants to cut rates so bad you can tell. Okay, they're talking about 3 rate cuts this year. They're talking about cutting the QT in half. That is bullish because that's less tightening and financial conditions are the loosest they've been since the beginning of this so-called tightening cycle. That's amazing because of all the facilities that the Fed and the Treasury are using to inject liquidity into the market. And now you're talking about lowering rates? Okay. And you're talking about curtailing QT and switching back to QE again? Okay, that's bullish. That's why everything went nuts this week. That's why commodities are on the verge of breaking out. That's why copper's over 4. That's why gold's making new highs. That's why Bitcoin's making new highs. This is the kind of stuff that's going to lead, in my view. As we start entering the recession, it's going to give the air cover for them to lower rates. It does not appear they're going to be able to get the inflation rate down to target. It looks like they're setting the stage. With the discussions, you can see it's starting to happen, right? It's not just one statement. It's a period over a period of time. Well, we don't necessarily need to get to the 2%. You know, we can live with 3%. Maybe we can also live with 200% like Argentina. Well, if you set a standard and you break your standard, lowering your standards are causing doors flying off Boeing aircraft and tires falling off of planes when they're taking off. What's next? Then it's just a slippery slope because they have no choice. They've got to get in there and start buying these treasuries because the debts are just increasing astronomically. And if they don't start getting into a rate cutting cycle, the ability to get this debt financed, the interest costs are just going straight up. We're over $1 trillion in interest a year. I think there's a lot of things at play, but it all leads to, again, all roads lead to more liquidity. And we've talked about this before. The rest of the world's already ahead of the Fed, and the ECB and the rate cutting cycle, they're going to come along. And the whole world will be synchronized upward liquidity cycle. So could we see new all-time highs in the stock market? Let me know in the comment section below what you think. Absolutely. I mean, this is shocking to me what they're getting ready to do. Again, it doesn't matter what I think or you think they should do or what we think their actions are right or wrong. We need to understand what the actions are going to be. The only reason we talk about Chairman Powell and the Fed is because, again, they have that bazooka, the liquidity bazooka. It seemed like they are putting it back into the arms locker. Now they're pulling it back out and polishing it, possibly getting ready to fire. A French economist that wrote about this back in the 1700s, and basically the thesis is that the closer you are to the creation of the money, or back in the Cantillon's time, is closer you were to the king or queen, the closer you were to the issuance of money, the better off you would be able to be because you have first dibs on any inflationary impulse or liquidity impulse. What I am talking about is the Cantillon effect. The closer you are to the cash, basically, the better off you're going to do. So let me talk about that in the context of this chart. Look down here at the bottom. This is the total net worth held by the bottom 50% of the people in the US. Then you see the red line, which is the net worth held by the top 0.1%. Then you see the M2 money creation, okay? Do you understand how this works now? When the Fed, when they get into the liquidity cycle, those that are the closest to the money benefit. And these people at the bottom, they're not close to the money. They don't own any assets. They're not able to take part in the asset inflation that happens during these liquidity cycles. What they end up seeing is when the inflation and the increase in money supply causes increased prices, that's what they get to see. Basically, a 20% increase in permanent prices, which we experienced over the last 2 years. But people that have been holding assets are doing just fine. So how does this work? It's very simple, right? You know, when the Fed wants to increase liquidity, what do? They lower rates. So what does this mean? Well, they have to go in and buy government securities, right? They have to make the bond price go up and the rates go down. Well, who are they buying it from? They're buying it from individual investors, institutions, money market funds, pension funds, and banks. So when these people sell their bond securities to the Fed, they get cash back. They don't just like put the cash in a mattress. They start looking around. They don't sell their bonds unless they have an investment that they think is going to return higher than the risk-free rate. So what they do is they take the $1 million they got and they say, okay, well, I'm going to invest it in the stock market. That's when asset prices start going up. Most of them will stick with the major S&P 500 index, which is a prudent thing to do. That's why you see the stocks that move with the market are mostly large cap. The Russell 2000 small cap index hasn't even close to, or it's still 18% away from making a new high. We can tell where the liquidity is going. It's going to the winners. Where are the winners at? It's in the index, and they are the kings and the queens that lead the S&P 500 or QQQ index, and the high just keeps going higher in the bull market. That's why I've said you have to be in this money game. Are you in this money game? Invest into high quality companies that liquidity will flow into. If you are just working and not investing, you are going to continue to fall behind. They're telling you right now the Fed is not going to hit the 2% target. Forget about the 2% target. Why is price increases of 2% every year a good thing for an average wage earner? It's not a good thing. You have a savings account that's getting nothing. You're getting stolen by 2, 3, 4% a year, and you don't get that back. There's no disinflation going on. So when they say, well, you know, we've got the inflation rate down from 9% to 3%, aren't we heroes? No, all you've done is decrease the inflation speed, and this is not over. If he really starts to cut rates, the second wave of inflation will be back. And the next thing you know is the Fed will raise rate again to 12% or 20%, just like in 1970 or 1980, respectively. We have average hourly earnings of production and non-supervisor employees in the red line. And then you have this personal interest payments rocketing above earnings is what this is showing. So, this is what I've been talking about, and this is why we're seeing higher credit card delinquencies and why the buy now, pay later are getting so much growth in the Cash App from my SQ block stock.
And is really popular with Gen Z and younger populations.
My kids had Cash App before. It was the first thing they had. And then I realized when I looked through your documents, there are 13-year-olds who are with it. And they'll be there for life.
Well, we have a families offering that is really unique because this is a population that's pretty underserved, and we get to grow with them. They're about 38% of our monthly actives, but only 28% of our inflows. So imagine the opportunity to grow as they become the spenders and earners of the future. So within Cash App, you have the opportunity to buy $1 or $10 of NVIDIA or Berkshire Hathaway. It's a really exciting opportunity to bring people in to stock investing. When we launched this product in 2019, what we saw was over half of U.S. households were not investing in the stock market. So this is an opportunity to make it more accessible and bring people into the significant wealth creation opportunities that others already have.
You spent $29 billion on Afterpay. How's it working?
Afterpay is an incredible opportunity to bring commerce into Cash App. We had over 20 million consumers on an annual basis using Afterpay with increasing frequency. These younger customers, Jim, don't trust the negative debt spirals that you see from credit cards. And so with Afterpay, we grew our gross merchandising volume by 25% in the important seasonal Q4 quarter.
Because of the inflation, they're trying to maintain to their living standard by whipping out credit cards and buying now and paying later up and trying to make ends meet. So this is going to end badly. Here's the Barron's Gold Mining Index to Gold ratio. You're at a level that we haven't seen since 1940. We're below that level. And so this is what's cheap. Gold mining stocks. I own gold stock. One of the two things is going to happen here. I think with the gold price breaking out and moving higher, making all-time highs, the gold stocks are either going up and reflecting that reality, or the gold price is way ahead of itself and it's going to come crashing down. But with the liquidity that we're seeing, with the all-time high depth that we have, with all roads leading to inflation, hard assets, things that can't be printed up or created out of thin air, are going to do very well. You've seen what Bitcoin has done. You're seeing now, like I said, copper moving up, the oil price breaking out. It's all driven by liquidity and inflation. Ultimately, liquidity will cause the inflation rate to go higher again. Then you throw on top of the fact that we're in the age of chaos and this regional war and Cold War with China, which uses a lot of energy and resources. How did we have the decades of low rate? It's all because we import deflation from China. Now we import less and less because of the decoupling from China. Well, China is still in deflation, so our inflation will go up higher and higher from here.
Because I have friends, family members, and all this. I say, why don't you buy some silver? No. Why don't you buy some gold? No. Why are you saving dollars? Because my mommy told me to save dollars. What do you say to those people? I get so tired of talking to them.
Central banks and governments buying and holding more gold than they ever have historically. Why would they do that?
And I bought my first gold coin in a shop in Hong Kong. And they said, if you take that into America, you're smuggling. So I decided to be a smuggler, and all this. But what happened in 71, what Nixon did was the dollar became debt. And what became the new money, I think called T-bills and T-bonds. Stockbrokers tell me it's safe as a bond. I go, you gotta be kidding me. I don't trust bonds as far as I can throw my building here. And so what's happened just now, they had a bond auction and nobody showed up? People aren't showing up to buy our bonds?
Exactly.